Good morning. Thank you all for joining us today for the 2023 Trend webinar. We are excited to reveal our new trend report to you, and today we're going to focus on decentralized finance. I'm Melanie Subin. I'm the Managing Director of Future Today Institute. And before we get started, I'll tell you a couple of things about me. I previously worked for a large insurance company, so I have a lot of background in financial services and insurance and what these different trends mean to those companies. I currently work on the decentralized finance portion of the financial services book, as well as Web3, which we will cover in an upcoming webinar. And finally, I've spent over 15 years in trends and corporate strategy, and so I'm excited to hear your questions today about what these trends might mean for your organization. Before we jump into things, let's go through a little bit about what FTI does. So FTI is a strategic foresight organization. That means all we do is use an evidence-based approach to anticipating the future. And in this course of work, we're looking at different trends coming down the road, different signals, as well as possible uncertainties. And the goal in strategic foresight is to be prepared. It's not to be prepared for every single thing, as that's not possible, but to be prepared for anything. And so we hope that in our trends report, we're giving you a little bit of information to help you see around corners and anticipate what might be coming down the road. On the left-hand side of the screen, you can see our funnel, our methodology. It begins with looking at factors that are influencing the future. That's what the trend report is all about. We gather signals throughout the year and then synthesize those into trends that we ultimately deliver to you every March. After we look at signals and trends, in the normal course of our work, we would then go into the scenarios portion of our work, which you can do on your own. There are a number of tools and frameworks available in our trend report that you can use. We identify uncertainties and then basically just pair those with trends to understand how things might turn out and what the next order implications might be. Finally, the most important thing about foresight is actioning for the future. And so in this phase of work, we want to take the scenarios, we want to see what we've anticipated for the future, and then decide what those mean for our organization or for your team or company. So you can see here, signals and trends is foundational to what we do and to how we do it. And that is why we produce this for you every single year. So let's get into the trends preview before we go through some of the decentralized finance trends. This is our 16th edition of the annual Tech Trends Report. Every year it seems to get a little bit bigger. This year we are sharing 666 trends with you. That is really the number. Believe us, we triple counted. And the report is pretty large. It's 820 pages. And so in order to help you find what's most important to you, we've broken it down into 14 different books. And those books cover different technologies like AI and robotics, as well as different industries like financial services that we'll talk about today. Every year, we choose a theme for our trend report and the way that we talk about it. Last year was reperception. We wanted companies to think differently about the trends that they were seeing and what it might mean for them. But this year, we've chosen the word focus. There is so much going on in the world. There are so many things that can be distracting that we really want organizations to key in on the main things that are important for them. And Amy said this in our trend report, it's crucial to focus when signals are forming, because some might be lasting and develop into impactful trends, but others might burn out and fade away. So with that in mind, today we're going to focus on decentralized finance. And when we say this, we don't mean to just take one thing at a time and focus individually. What we really mean is to pull out the things that matter to you. So as I'm talking through today's content, don't feel like you have to take everything back to your teams. Consider today a shortcut to reading the full report, and then take back the few things that you think are really important for you to explore further. You heard from Kriffy yesterday on the financial services webinar. This is part 2 to that webinar. Today, we're focusing specifically on decentralized finance trends and are looking through all of the different trends contained in that section, as well as a quick intro into what happened last year with the crypto winter. So before we begin, let's define decentralized finance. DeFi is a term that's being used to describe basically the use of blockchain and crypto in financial applications. I want to separate this out for a moment because it's often conflated with the Web3 space. Web3 will come up a little bit in today's webinar. It's the underlying technical infrastructure that includes blockchain protocols and mechanisms, and it's used to support blockchain applications. So you can think of Web3 as the foundational layer. And we will have another webinar on Web3 if you're interested in those trends as well. Web3 infrastructures, though, support all the different applications that are based on blockchain, like DeFi applications. So they're related, but there are two different levels and there are two different applications that we're referring to. So for the next hour, we are specifically focused on blockchain-based financial applications and crypto in particular. So I can't start talking about the crypto industry without first beginning with the poly crisis. So let's start with how all of this happened. A lot of people blame Terra Luna's death spiral, as it was called, as the catalyst for the 2022 crypto winter. This began in May 2022. Luna depegged. What that means is that its token was no longer tied to the value of the US dollar. And as a stable coin, that's its key selling point. So there was capital flight, there were a number of large dumps of the coin, and the value of Terra Luna decreased, and it depegged from the US dollar. So Terra deployed more capital to try to defend the peg, meaning to bring it back up to that $1 value, but that did not work. Ultimately, Luna forked into Luna Classic. Forked means that it took a different strategic direction. And in this case, it was a hard fork. So it turned into a completely different coin. And then New Luna, L-U-N-A, was formed, and that solidified the losses. If we were talking about stock, we would talk about it as a realized loss. So as a result, many of its main lenders, BlockFi, Voyager Digital, Genesis, issued margin calls, meaning that the value of Luna fell below a certain threshold and it needed the capital backer to provide more capital to meet the margin requirements. Three Arrows Capital, one of the main backers, failed to meet the margin calls, and that sparked fears of insolvency. So the Luna crash was one of the biggest things that happened, and the cascading effects of that failure really put the crypto industry and lenders in particular in a pretty vulnerable position. And that lost investor confidence as well as almost $200 million. Later in the year, there were a number of losses last year, but Luna was sort of the big one that kicked everything off. And then later in the year, we saw a familiar scene play out as FTX quickly spiraled, although notably for different reasons. So let's see how the FTX spiral played out. So initially, CoinDesk issued a report that called into question FTX's liquidity and overall management. That was on November 2nd. And I'll note that Luna's downfall, everything we see there, happened over the course of about a week. With FTX, on November 2nd, we see a report comes out. This decreases confidence in FTX. And then just a few days later, Binance issued a statement that it was going to sell off all of its FTX token, which is a pretty big deal and decreased confidence as well. A couple days later, Binance says they're actually going to purchase FTX. So they're going to become the new owner of FTX. They hadn't done due diligence yet. They made this announcement publicly, but then a day later had said that they did due diligence and now they've reversed their decision. They don't want to purchase FTX. And this sort of back and forth really decreased investor confidence in the market because what it said was that there really is something very wrong happening at FTX. After that, a regulator in the Bahamas froze FTX assets, and then a day later, FTX declared bankruptcy. And we've seen the timeline go on from there. So the crypto industry really relies upon capital backers and market makers in order to function. Right now, FTX, as an example, owes more than $3 billion to top creditors. Ultimately, the downfall of creditors like Genesis, who are now declaring bankruptcy, is a main driver behind the cooling crypto market and is going to cause ongoing investor hesitation until we see that capital and those creditors begin to recover. So that's a little bit about how we got there, a quick overview of the crypto winter, so to speak, and the events that led to the downfall. But let's hop into the DeFi trends. And the first one we're going to cover today is actually really relevant to the Terra Luna story, and that's stablecoins. So Terra Luna is a stablecoin. Stablecoins are cryptocurrencies that are pegged to a fiat currency, most often the US dollar. It means that any crypto issuer can make a stablecoin, but they're not literally backed by fiat currency. Some of the more common ones that you've probably heard about today are Tether, Binance, TrueUSD, USDC. And as crypto markets continue to be rocked by declining value and the very public crash of notable players, stablecoins are a bridge to building trust because people understand what their value is at any given time. As of last year, stablecoins made up a huge proportion of the crypto market, about 165 billion market cap. However, they experienced almost a $60 billion loss last year from Terra alone, so that market cap has come down substantially and is still recovering from those crashes. Because of those crashes, the Transparency of Reserves and Uniform Safe Transactions Act, the Trust Act, was introduced in 2022 in the US Senate to regulate how stablecoins are used for payments. It requires things like stablecoin issuers have to obtain a license from the Office of the Comptroller of Currency. We're going to talk about how regulation is impacting the crypto market and the DeFi market in this space, as well as in staking. But overall, one of the main themes that we're seeing from last year is that regulators have really begun to pay attention to what's happening in the crypto market because of the size of the losses. I think the Trust Act is one really big marker for stability in the crypto space. And then the White House's comprehensive framework for the responsible development of digital assets is another call for greater asset stability. We also saw that after Terra's crash, those who were behind it committed to only holding the most secure reserves on the market, US Treasury-backed securities. So this is another movement towards increased stability, particularly in the stablecoin space. Stablecoins are going to be extremely important for transactions. And if the trust building goes smoothly, I think they're going to be rewarded with a greater market share, but it's going to take some time to rebuild that trust, as well as the capital and the credit market. So that's stablecoins. Stablecoins are pegged to a fiat currency, but they don't literally represent the fiat currency. CBDCs, on the other hand, do represent a fiat currency. They are issued by a central bank, and they are representative of the actual dollar that you hold in your wallet. So if you have a US dollar in your wallet in paper form, or you have a US dollar in your traditional bank account, or you have a CBDC that represents a single dollar in your digital wallet, those are all equivalent. They are all a US dollar. So the map that I'm showing here is from the Atlantic Council. They track CBDCs across the world. And you'll note here the pink countries are the ones that have actually launched a CBDC. There's only 11 of them. There are really very few. And then the green countries are in a pilot stage. There's only about 11 of those countries, or 18 of those countries. And then we've got a little over 70 countries that are either in development or doing research on issuing a CBDC. And those are in teal or blue on this map. So CBDCs will probably take longer to scale because governments and central banks take a much longer time to take action on things than a new crypto startup, for example. There are a couple of new developments since we issued our trend report that I wanted to share with you today. One is in Spain. So a coalition of over 24 banks is currently testing the impact of a digital euro. So the banks are working with payment processors like Iberpay and Resis to see how a digital currency backed by the European Central Bank would work within existing payment systems. The tests are currently ongoing. They're scheduled to be completed this year. And they're going to look at use cases like sending remittances in digital euros, e-commerce payments, and then payments that include other digital currencies. So this is a pretty important exercise. Understanding how CBDCs could weave into existing payment structures and be seamless across current settlement systems is going to be key to them scaling. If they require an entirely different system, it's going to be very difficult to scale the adoption of CBDCs. In the UK, similarly, the Bank of England recently recruited developers just in December to build a digital wallet for a potential CBDC. So the contract is going to cover the development of a wallet that can be used to launch a mobile app, a website, and a server that can connect to an API. And then that wallet can store information on users, it can track payments, and it can provide a way for users to register and change their details. It's about a 5-month project, so it's going to take a little more time to see what the results are, but this is very promising that main countries and main central banks are actively experimenting and investing in this space. That tells me that we're going to see CBD scale over the next couple of years, depending on the adoption of them within the technology space and the development of the necessary settlement systems. Looking at a different topic now, thinking about social and digital payments. So yesterday you heard Kriffy talk about embedded finance. Embedded finance is similar to a card on file system. Social and digital payments are similar in benefit, but a little bit different in terms of the mechanism that underlies them. So social and digital payments today, while they're tied to traditional cards and bank accounts, they're helping to monetize social interactions and then embed exchange within them. So companies are facilitating social transactions to position themselves well for any resulting commercial transactions. In other words, as we see the increase in social and conversational commerce increase, as we see things like metaverse applications increase, companies want to be prepared for how value is going to be exchanged in those environments. So one example is conversational commerce companies or chat-based systems. They could enable financial transactions within social conversations. Apple already enables this within iMessage through the Apple Cash payment functionality that you can see on the screen. I'm sure many on this call have used that before. And they also embed it for business accounts on iMessage that couple customer service with on e-clicks links to payment portals. So this is things like FIS and Stripe enabling chat-based payment functionality. The increasing marriage of commercial interests with social interactions, meaning be able to make a transaction in a social interaction, is making it easier to facilitate transactions. So in the future, these could be made even more secure and streamlined through the implementation of tokenization or cryptocurrencies like CBDCs or stablecoins, assuming that we see an increase in transaction settlement speed, which we'll talk about in a couple of minutes. But the other thing that companies need to keep in mind when we think about social payments is consumer backlash. Companies will need to make sure that they navigate that fine line between enabling consumers to do what they want to do without entering into their most private moments, without consumers' knowledge or permission. In order for some of these payment capabilities to be predictive, for example, or to pop up at just the right time, it means that technology has to track what's happening in that social interaction. And that's something that we haven't quite figured out yet, and consumers may not be comfortable with their social interactions being tracked in that way. Next, thinking about regulation again and consumer protection, staking has been a huge topic of conversation over the past few months. So staking allows you to earn rewards or interest for holding on to certain cryptocurrencies in your digital wallet. And it's the basis of proof of stake protocol. So we'll talk a little bit more about that in Web3, but proof of stake is more environmentally friendly, it's less resource intensive, and it's increasingly the validation mechanism of choice. Main blockchains like Ethereum use proof of stake versus Bitcoin, which uses a proof of work. And it's a big source of passive income. So especially for investors who have a meaningful amount of crypto to stake, it's a big way that they can earn interest. It's similar to an old school certificate of deposit. You put your money in, you promise not to touch it for 6 months or 9 months, and you earn a certain amount of reward for that. Staking is the same idea, but with holding crypto assets in your digital wallet for a predefined period of time. So recently, why has it come under fire? It's come under fire because the SEC is arguing that staking and staking as a service is actually subject to securities regulations, that it constitutes an investment similar to that which we see regulated under traditional SEC laws. So the most recent example that came out just shortly before the publication of the report resulted in an agreement by Kraken, which is a crypto exchange, to pay a $30 million fine and end its staking offering. And that was all to appease an SEC accusation that its staking product amounted to selling unregistered securities. As of the most recent publication, what we've heard is that the SEC is investigating virtually every single cryptocurrency offering that has some sort of staking product embedded. And some experts are worried that the regulatory attention is going to cool demand for staking. But what's more likely is that staking products will just change how they offer the reward. So by changing the benefits offered from interest benefits or appreciation of value, the mechanism underlying it could be changed to still be a reward, but circumvent some of those SEC regulations. If all staking practices come under fire, which a lot of experts think is unlikely, but if it does happen, it could threaten the underlying proof of stake mechanism. And proof of stake, again, is one of the more popular mechanisms being used today. However, we need staked funds in order for that mechanism to work. And so if we do see staking come under fire, we might also want to look over to blockchain protocols and watch how those are changing as well. Speaking of staking, supporting proof of stake, which is more green, there has been a lot of conversation about crypto's energy intensity and how many resources it requires to work, particularly when we think about proof of work. So just for a moment, if you look at that picture, this is a person who's inspecting a number of different blockchain nodes. Proof of work basically says that you need an enormous amount of computing power to solve very complex puzzles in order to complete the work to validate a transaction in a block. So you can see how this would be incredibly resource intensive. It requires a lot of computing power, which therefore requires a lot of electricity and a lot of energy. And that energy intensity has been one of the key criticisms of blockchain since its initial emergence onto the mainstream market. The White House actually issued a fact sheet last year highlighting that global electricity usage for crypto assets could be as high as 240 billion kilowatt hours per year. That's more energy use than most countries use on an annual basis. So while most of the focus is on making crypto greener, the shift has been from proof of work to proof of stake. There are other innovators who are trying to come up with other ways to make crypto greener. One example is the Satoshi Action Fund. This is a nonprofit organization that focuses on blockchain operations. And they proposed a solution where more than 80,000 orphaned gas wells, meaning gas wells that were sort of left, they weren't completed, they weren't capped, that those gas wells could benefit crypto miners. And the proposal said that Bitcoin miners could adopt an orphaned well, use the remainder of the gas in that well to mine crypto, and then as a result, they would take a responsibility for sealing it. So this would use up existing orphaned gas wells that need to be resolved anyway and provide the necessary energy for crypto mining. Another solution includes using nuclear energy. So nuclear is a big sort of topic of conversation in the energy space, a potential solution to traditional carbon-based fuels. And rather than oil and gas powered utilities, people want to use nuclear to power crypto mining operations. So one example is a new crypto mining data center in Susquehanna, Pennsylvania, and it runs exclusively on nuclear power. So this could be another mechanism for decreasing the overall impact and the carbon footprint of cryptocurrency while enabling mining to continue. Over the past year, it's important to note that a lot of governments have posed the idea of banning crypto mining. So in particularly, the European Union saw support for the idea from member countries like Germany and Spain and Norway. And banning mining might not have the positive impact that those governments hope for. There was one study recently that showed that following China's ban, miners moved to other countries nearby, including Kazakhstan, where they had access to far less renewable energy than was available in China. So in short, mining globally got a lot dirtier when China tried to ban it in order to be greener. Ultimately, the solution to a greener crypto is going to come through a combination of things. one solution isn't going to do it all. We need to be looking for signals around a translation to nuclear energy and other sources of energy, such as renewable, as well as new mechanisms to decrease resource intensity like increased computing power. And finally, I want to talk about layer 2 enablement. So when we're thinking about DeFi, layer 2 is a layer within Web3. It's one step above the foundational infrastructure. Things like Bitcoin and Ethereum are typically identified as layer 1 chains because they process transactions individually. Layer 2 protocols are the frameworks that get built on top of those chains, and they enable the chains to scale. So layer 2 protocols like Immutable X and Polygon are going to increase transaction speeds while reducing prices, but using layer 1 connectivity so that they can maintain that security and the decentralization. So there are a variety of different mechanisms for layer 2 protocols. The current preferred solution is Ethereum rollups. Rollups can reduce transaction fees by up to 100 times, and they do this by bundling hundreds of transactions into a single layer 1 transaction. Most popular cryptocurrencies like Bitcoin and Ethereum have the scale of users to offer a more mainstream solution. The problem is the speed of transaction settlement. So you can see in the visual on the screen here that while Ethereum can process around 20 transactions per second, Visa can process 24,000 transactions per second. So these cryptocurrency chains lack the settlement mechanisms to compete with the volume and the speed and the price of settlement that we see from networks like Visa and MasterCard and SWIFT. For these chains to serve as the ledgers for these daily use currencies, they're going to need to greatly scale the number of transactions that they're able to process per second while still minimizing the price per transaction. So that was a very quick overview of the DeFi trends that we've covered in today's book. I'll swing back to the beginning reminder that not every single one of these trends may be impactful or necessary for your organization. And so I would encourage you to review the overall report as well as the financial services book and look for the specific trends and factors that you and your team need to focus on. It's not going to be all 666 trends. It may just be a handful. But these are going to be the areas that you can focus on and that you can really make great strides in by looking at just those few key areas. And finally, one of the key mantras that we use in FTI is to think exponentially, but act incrementally. And what this means is to think big, think far out, think about where you want your organization to be, even if you're not sure whether or not you have the resources to do that today, but then act incrementally. So take individual steps along the way to get to that long-term vision. Thank you all for joining today. I'm happy to pause for a few questions if there are any. If you were not able to join or if you have any colleagues who wanted to watch, we're going to be posting these webinars on the website after completion. So you are feel free to share. You're welcome to come back and email us if you have any questions at that time. Kriffy, my colleague from the financial services book, is joining me here today. Kriffy, any questions you think we should cover for the audience or anything that came in during the conversation?
Let's give it a couple minutes so people can use the Q&A function in Zoom, please, and type some of the questions in. There was one comment about the taskbar in the slides, but we didn't want to interrupt you.
Got it. Yeah, well, hopefully we'll correct that in the recording that we share. Yeah, I mean, one thought that I'll close on is that a lot of the material that we covered in today's webinar really looked at the complexities of some of the things that have happened in DeFi and in the crypto space over the past year. If you're not in the financial services industry, if you are perhaps tangential to it, or you're developing capabilities or tools for the financial services industry, it may not be as imperative for you to know the underlying reasons that things have happened, like nuances of margin calls. What's more important is to really just look at the instruments, the tools themselves, and to understand what impact that might have on what you do. Barry, I see your question about the direct link. All of the trend reports are free and available for download on our website at futuretodayinstitute.com/trends. We have one additional question here. How does the trend to DeFi conflict with the growing nationalism on the multipolar world? Yeah, I mean, this is an interesting one because I think one of the complexities that crypto organizations and crypto issuers will have to contend with are the differing regulations across countries. But at the same time, that's sort of in conflict with the idea that cryptocurrencies can be really helpful in an increasingly polarized world because they can enable transactions to happen more seamlessly across different financial systems. So if I were giving advice to a crypto issuer, for example, an organization that offers staking products, I would say that those that will scale the fastest will be the ones to look for sort of the lowest common denominator in terms of what is allowed through regulation. So looking across main central banks and main regulatory organizations like the US, the Fed, the EU, central bank, looking at different regulations across the EU, and then obviously looking into Asia and the various different regulations happening across countries there, we're going to want to look for the lowest common denominator of what is allowed, and the cryptocurrencies and the products that meet those requirements are the ones that will scale because they can be used in any of those different countries.
I think that dovetails into the next question quite nicely, which is about traditional banks and how to kind of incorporate traditional banks and DeFi into their offering. So how do those two connect?
Yeah, so I think it depends on who's incorporating traditional banks and DeFi into their offering. So for example, if you're a retail organization, I think what we'll see is that anywhere transactions are happening, for the foreseeable future, consumers are going to need the option to use either cryptocurrencies or DeFi options, as well as more traditional options like a bank account. It is going to take time for consumers to adopt these technologies. And so I think adoption will be a little bit slow at the beginning, but the more those options are embedded into offerings, we might see consumers begin to experiment with them. From a DeFi perspective, I think there's a lot to be learned from the settlement mechanisms of some of the bigger, more traditional financial players that we talked about. So I would anticipate looking for partnerships possibly, particularly some of those bigger settlement mechanisms, possibly making an investment into cryptocurrency or those different tools or payment capabilities to expand their offerings while still sort of leveraging the settlement pluses and bonuses and capabilities that they have that some of the smaller DeFi organizations just don't have yet.
And a follow-up kind of related question to that is taking it to the extreme of some people believe that crypto can replace traditional banking. Do you have a perspective or what do you think of how likely that is?
Well, Kriffy said yesterday that he was a crypto minimalist. I would say that I'm a pragmatist when it comes to this question. Things like CBDCs, I think over the long term, have a potential to replace things like cash. But that's over the much longer term. There are a lot of things that need to be fixed and decided upon in existing systems in order for that transition to take place. But CBDCs, I think, have the biggest potential because they're just replacing and digitizing existing fiat currency. So we're not worried about the volatility of the market. It's just a different mechanism. I don't think we're going to see Bitcoin or Ethereum outpace or replace traditional global fiat currencies like the euro and the US dollar. What I do think is that we might see cryptocurrencies like that become the main source of transaction and the main instrument used in certain key use cases. So for example, in particular industries that have a lot of international or global transaction and exchange. But I don't think we're going to see consumers foregoing the US dollar for Bitcoin anytime soon.
So the next question we have is, how should investment firms think about DeFi when it comes to the long-term financial goals of the various stakeholders?
Yeah, so I mean, I think that DeFi and cryptocurrencies are an investment just like any other, particularly in staking. And we are seeing investors putting money away in staking to reap those benefits. I think how should they think about it is just the same way that they would think about it in terms of any other stock purchase or portfolio management decision, which is it's based on the risk appetite of the investor themselves. So I don't think we're going to see DeFi go into any index funds, but we are seeing larger investors look at staking as a potential opportunity to make a big increase over a short period of time.
So the next question we have is the role of incumbents in traditional finance, and how could they help regulation move forward or proactively? And so how does traditional finance and DeFi intersect with regulation?
Yeah. So for me, there is a parallel here between DeFi and other topics like artificial intelligence. Traditional financial services companies are the experts in this space. They understand what the risks are, they understand the downfalls, they understand what underlying mechanisms need to be present in order to protect the financial services ecosystem as it is and the infrastructure. So to me, they should be partnering with lawmakers, informing regulators to make sure that they're sharing the very detailed knowledge that they have, not of any special sauce or secret sort of development that they have going on, but rather to inform lawmakers and regulators about these instruments and how they work to help influence the way that regulation and laws are developed to make sure that it's covering the right things. Just like AI, this is a very technical, very new space. And lawmakers and regulators have to watch a wide variety of spaces and can't be an expert on every single technology that comes our way. So I think large financial services organizations have a role to play in influencing that regulation and making sure that ultimately we create a cryptocurrency ecosystem and industry that is safe for consumers to invest in and participate in.
I'm going to take two questions and kind of mix them together for you here. Hopefully that doesn't throw you too much for a loop. But one of the questions is about DeFi being distributed kind of in developed economies or countries versus developing, which I think connects to a question around centralization versus decentralization.
Mm-hmm.
And so I think the question or the comment that I was hoping to have you talk about is, what do you feel about centralization versus decentralization and how that relates to kind of who has power when you think about economics or economies?
Mm-hmm. Well, I'll give you my answer and then I'll throw it back to you to see if you have any thoughts, Kriffy, because I know that this is a space that you think about a lot. I think that the nature of developed or developing nations is obviously going to influence the way that different cryptocurrency instruments and coins are adopted. So in developing nations, where there may technically be a centralized organization, but maybe it's not quite as powerful or influential as, for example, central banks in Europe or the US, I think that cryptocurrencies could help to create a more secure and reliable underlying financial infrastructure where maybe one hasn't existed in the past. And in particular, cash is king in a lot of developing nations. And so cryptocurrencies and other, stable coins, other coin offerings and tokens can make it easier for individuals to exchange value in a way that is more secure and enables them to ensure that their money comes to them when they expect it to, and that they are able to get it to the person that they expect to receive it in the end, which can be a little bit trickier when you're working with literal cash. Do you have any additional thoughts on that?
Sure. I have the pessimistic spin to it.
Great.
Well, so I think it is very fascinating. I think there's also the developing economies is a very interesting proving ground because they're used to using different currencies for different reasons. It's less of the kind of Euro US mindset where there's just one system that you use, you have one currency. So I think that's why there's a lot of excitement developing around it. And then for the centralized versus decentralized, I think as things evolve and they get bigger, decentralization from a organization and kind of how you make decisions standpoint becomes a bit of a myth, in that the more and more you evolve these things and the bigger they get, you have whales, you have other mechanisms where the governance ends up still being a certain number of entities that make those decisions. So it's difficult to be, fully, totally democratic in any of these systems as they get large.
Yeah, that's a good point.
But we have another question, which is
Sure.
how should product and service designers act now in light of all of these trends that are coming in decentralized finance?
I think if we're talking about just uniquely the payment mechanism, I think that's really where it's going to change the most. So what I mean by that is when we talked a little bit about the relation to embedded finance and social and digital payments, right now, when you make a payment, you sort of know that you're making a payment, and that decision point is happening at the same time. What we're going to begin to see is that it is more embedded, that it's not necessarily a button that you click. And so I think that with any of these, whether it's a token of a traditional bank account or a stablecoin or a CBDC, the instrument itself doesn't really matter. But I would begin to think more about how can you make that transaction decision and how can you make that transaction approval a little bit more holistic and a little bit more invisible within social interactions as well as commercial interactions. There are some existing, not DeFi, but existing fintech solutions today that are making payments very rapid, particularly in the embedded finance space. But I think that's just the first step. So as a product and designer and an interface designer, I would be thinking about how can you make those transactions secure, but invisible so that people don't sort of reach a stopping point when it's time to make their purchase decision, but how can they continue moving throughout it more organically? Is there anything you would tie to that from the embedded finance or invisible banking perspective that I missed?
Yeah, well, not missed. I would just add is that whole commoditization is, I guess, the key word around it of it being invisible and all back end, and you're not going to be able to see it. And I think the aha there is the concept of an algorithmic purchaser, right? Is that you're getting further and further away from a human having an emotional decision for choosing something to happen in one way or another way. And I think that's something that you're going to have product designers developing towards or have to start considering in how they develop, which is the next iteration of, like, let's say the last 10 years was API-ification. You're going to have to start thinking about commoditization, so to speak, or being invisible.
Yeah. Yep, agreed.
So our next question is key milestones to enabling greater DeFi adoption.
I think regulation is the most important one. We saw from just the activities of last year that we're going to need some better guardrails for both financial services players to operate in, as well as for crypto issuers to operate in, and then all of the users of those. For example, somebody asked about investment management and wealth management previously. So regulation is going to need to dictate what about these tools needs to be true in order for them to remain safe. What are some of the activities that we don't allow, or what are the guardrails around those activities? And I think that might vary by the type of instrument. So the guardrails that we put around a CBDC is going to be dramatically different than the guardrails that we put around a Dogecoin. And so I think that we're going to need to see much more in-depth regulation that really acknowledges the details and the nuances of these instruments. In addition to that, I think we're going to need to see it be made a little bit more accessible to the mainstream consumer. So right now, there are a number of digital wallets. Binance is one of them that you can go on and you can purchase a crypto or a coin. But I would venture to say that the vast majority of individuals don't know how to purchase cryptocurrency today. If they do know how, they're not sure which one to purchase. And so it's creating a lot of choice that most consumers don't feel like they have the information to make that choice. And so I think that we also are going to need to see the sort of mainstreamification of cryptocurrency into something that consumers feel like they can understand and they can make an informed decision about.
Wow, you stole the next question, which is around the kind of the future of wallets and how are they going to evolve and sort of that spectrum.
Yeah. If there was one thing that I had to say about what I hope for digital wallets along those same lines, it's that they'll become a little bit more predictive. So for example, if a user has a digital wallet, they have all of their different accounts connected to that wallet, and they say they want to purchase a cryptocurrency, then they could go into a portion of that wallet where they can purchase that cryptocurrency, and the wallet would make a recommendation for them based on existing holdings, based on risk tolerance, based on age and goals. they'll be able to get a recommendation for what they should purchase. I think that sort of predictiveness around cryptocurrency investment is really going to help individuals make better decisions. And we saw this a little bit with the rise years ago of apps like Robinhood that sort of democratized investing and made it accessible for people who didn't have a lot of familiarity with the stock market, weren't really sure how to engage in it. I think that we're going to need to see a similar technology in order to democratize cryptocurrency within digital wallets. And then I also think digital wallets really need to be seamless, which means financial services institutions are going to need to be willing to play. So if you are a member of a large national bank, it's probably pretty easy to tie your accounts into some central tool. But if you have a credit union, if you are a member of a smaller bank, a community bank, a lot of those banks still don't have the infrastructure or the technology for you to easily tie into them. And so I think that's going to be a real barrier. And that's something that we'll need to solve at the individual financial institution level rather than at the wallet level.
So I'll push you on this because I think it might be fun, controversial.
Okay.
Do you see that the wallet is a piece of your online banking, or is it something that exists outside of your online banking? Right? Is it your large retail, say like your Chase,
Yeah.
the function of your Chase online banking app?
I think they're one and the same, but they might have different interfaces because of how you're using them. So for example, I think I need to be able to access transaction information in my digital wallet. But if I'm in a store, then there's a different mobile interface that I'm using to make a payment. And I'll come back to the predictiveness for a moment. I think digital wallets will also be able to make some semi-autonomous decisions about how to make that payment. So should it come out of my credit card? Should it come out of my bank account? Should it come out of a cryptocurrency holding? So I think ultimately digital wallets should comprise all those different functions that online banking and wallets currently provide separately, but I think the interfaces need to be different. So I can log on a desktop and view my transactions, but I can also have digital wallet capabilities that are tied in through my browser-enabled purchases. But then on my mobile app, I also have a more seamless, sort of streamlined view that I can use when I'm out in the world making purchases. What do you think?
Awesome. I love the answer. It sounds a little bit like convergence, but it also sounds like, let me do what I want to do when I want to do it and where I want to do it.
Yep.
Which dovetails a little bit into another question we have here. I'm going to try and paraphrase it into the right options, which is a little bit of like how far things are out, a little bit of of kind of an outlook on when things are coming, which is around regional blocks adopting crypto, in addition to the existing regional block currencies as customer facing everyday payments. So I think part of the question there is, do you see large groups of areas like the Americas using crypto as an everyday payment and kind of how far are we away from that?
Yeah, so I'll actually go back if I can get to the slide. I want to go back to the map that we had, because I think that gives us an initial perspective on maturity. So how mature are certain countries in this space? So what we can see is that actually there are very few countries, and there isn't really a block per se where those regions are ready for full-scale adoption. If anything, I would actually say the Caribbean is the furthest along in terms of adoption. There are a number of countries in the Caribbean that already have live, active CBDCs. And the reason I'm pointing to CBDCs is because that suggests to me that the government, the regulatory bodies, the central banks have sufficient fluency in cryptocurrency to scale for that society to scale adoption of cryptocurrency overall. I think CBDC development is an interesting proxy for readiness. So in the United States, for example, I think that US in particular, but North America overall, is going to be much slower as a region to adopt cryptocurrency. And some of that is just values-based. North America and the US is not, and I hope I'm not stepping in it, but it's not the most progressive region. It's not the most technologically curious region. And so I think that as we consider sort of big different blocks across the globe, North America and the US will be a lot later to the game. I think Asia will come first, China and Japan in particular, following the Caribbean. And then I think Europe will follow closely after that. And I think US is looking to Europe's lead for that. So that's both in terms of CBDCs, but also in terms of societal adoption. So I think cryptocurrency overall, really mainstream adoption for North America, I don't want to put a number on it, but several years out at least. I think for regions like Asia, maybe a few years out, and I think Europe is somewhere in between. So I know that's a non-specific answer, but the long and the short of it is not this year, not next year, partially due to regulatory hurdles and partially due to societal readiness, which was definitely impacted by the downfall last year in the US market.
Yeah, I would add to that it's not a technical issue, which makes it really hard to predict, right? From a technology standpoint, enabling the acquirer or that point of sale device to accept a different form of payment is not an impossible hurdle. Yes, it's a few years or a year of programming, but that's not the holdup, which makes this very, very hard to predict.
Yeah, I agree. All right. So with that, I want to thank you all for your time. It's been an exciting conversation. We love getting the questions. Again, if you have any lingering thoughts after the webinar, please feel free to reach out to us. You can download the trend report at futuretodayinstitute.com/trends, and we look forward to hearing from you soon. Have a great day.